Are we heading for a stock market crash in 2025? With stocks hitting new highs and the recession warnings growing louder, the tension is building. And investors are nervous. No one wants to risk their savings if the markets can drop by 50% in the blink of an eye. In this video, we'll break down the current market, compare it to past bubbles, and explore what steps can you take to protect your investments. Let's get into it. In 1928, Charles Merrill, the founder of Merrill Lynch, took a bold step. Convinced that equity valuations were unstable, he sold many of his holdings and warned his investors to do the same. And shortly after that, the stock market crashed and the Great Depression began. It's a great reminder of how markets can spiral out of control when valuations run too hot. Fast forward to the 1980s, when Japan experienced its most infamous asset bubble. During this time, both real estate and stock prices skyrocketed, as investors poured money into the markets, convinced that prices could only continue to rise. Nikkei 225, the index of 225 Japan's leading companies, soared from 10,000 yen in 1985 to a peak of almost 39,000 on December 1989. A staggering almost 290% increase in just 4 years. But by the early 90s, the bubble bursted. The Nikkei index plunged by nearly 80%, falling to less than 8,000 yen by the year 2003. This bubble burst marked the beginning of a period of stagnation in Japan's economy. It took nearly 35 years until July 2024 for the Nikkei to surpass its pre-crash highs. And let's not forget the dot-com bubble in the late 1990s. Investors got caught up by the euphoria of the internet potential and ignored the fundamentals. When the bubble burst in the year 2000, it wiped out trillions of dollars of market valuation and sent global markets into turmoil. History teaches us that bubbles don't form overnight. They are built on years of optimism, high valuations, and misplaced confidence. So, the question is, are we seeing the same thing today? To answer that, we have to clarify the difference between expensive and a bubble. Expensive markets have high valuations but don't necessarily indicate irrational behavior. Corrections in these cases can hurt, but rarely lead to deep depressions. A bubble, on the other hand, is different. It's not just about high valuations, but also about irrational psychology. There is this famous quote by the legendary investor Sir John Templeton. The four most dangerous words in investing are, "This time it's different." And here's the thing, I already hear people saying exactly that. These words signal overconfidence, the belief that traditional rules no longer apply, and they're often the precursor of disaster. A bubble bursts when euphoria fades, leaving investors scrambling and economies in turmoil. So are we truly there yet? To put things in perspective, let's look at some numbers that could suggest we are currently in a bubble. The US large cap stocks are currently trading at almost 27 times trailing earnings, placing valuations in the top 10% historically. Additionally, the S&P 500 is trading at a 27.9 PE ratio, a 54% premium to its historical average of 18.1. You might ask, how could this have happened? Well, the S&P 500 has rallied nearly 27% in 2024, following a 26% gain in 2023, marking a remarkable 60% increase over the past 2 years. These numbers sound great, however not that crazy, right? But what if I would tell you that this kind of a rise has only been recorded once before? Back-to-back annual gains of at least 25% have only happened once since S&P 500 was established in 1957. The index rose by 33% in 1997 and then by 29% in 1998, fueled by the dot-com bubble, which drove stock valuations to dizzying highs. Current market dynamics show similar excitement, with metrics like market cap to GDP and household stock allocation reaching the highest levels in 40 years. In summary, the current market's rapid growth and elevated valuations look a lot like past bubbles. But does it guarantee a bubble burst and a stock market crash in the year 2025? Let's explore why the situation today might not be as bubbly as it seems. There's one critical difference. Bubbles involve widespread euphoria. In the late 1990s, everyone was investing, and smaller companies with only a website and no real business plans were valuated like giants. You could compare it to the recent crypto hype, where cryptocurrencies with no real value reached absurd valuations. For example, Dogecoin, a cryptocurrency created as a meme, had higher valuation than Ford this year. In my opinion, that level of irrational exuberance isn't the case now. Most of the market's gains come from just a few companies, the so-called Magnificent Seven. Outside of this group, valuations are lower, but still high. Also, brokerage activity isn't exploding, and mainstream media isn't obsessed with stocks. Additionally, as I mentioned, the S&P 500 is trading at a 27.9 PE ratio, a 54% premium to its historical average. However, in the dot-com era, the PE ratio climbed to 34, so theoretically, the market could still go higher. Finally, continued rate cuts by the Fed could further boost market valuations by making borrowing cheaper for companies and reducing the appeal of safer assets like bonds, encouraging more investments into stocks. As we assess whether the current market is truly in bubble territory, it's important to broaden our perspective beyond the US. While the US stocks are undeniably expensive, with valuations at historic highs, the picture looks very different globally. The European and the UK markets, for example, trade at discounts relative to their long-term averages, presenting potential opportunities for investors willing to look abroad. While most of the attention remains fixated on the US stock market, it's completely overshadowing other regions like Asia, South America, and even Africa. For example, in my opinion, the Chinese market stands out as especially undervalued, offering an intriguing contrast to the lofty valuations dominating the American markets. So, are we in a bubble that's building up for a market crash or not? The answer depends on how you look at it. If we focus on the US market, yes, I think we are in a bubble. However, this bubble could remain stable and continue throughout 2025, not causing a market crash. On the other hand, if we expand our view to other global markets, the picture changes. In many regions outside the US, we are not in the bubble, and the valuations might not seem as stretched. The global landscape presents a more mixed picture, and it's crucial to consider regional factors when you're evaluating the potential for a crash. So what can you do and how can you adapt to this? If you're struggling to find investment opportunities, do not focus solely on the US. There are plenty of promising investments globally, and diversifying internationally can offer solid growth opportunities. Additionally, if you're uncertain about the markets and do fear a crash, you can always consider bonds. Currently, they offer around a 5% annual return, which provides a safe and steady way to wait out the market volatility while still getting a reasonable return. Now, tell me, what do you think? Are we on the edge of another dot-com-like disaster? Or is this just a temporary overheating? Let me know your thoughts in the comments. And as always guys, thank you for watching, thank you for sticking to the end. If you enjoyed the video, consider subscribing and hitting the like button. Again, thank you, and I hope to see you in the next one. Bye.